it's a loan that you're taking from the insurance company that you set the terms. They're not going to set the terms. They're lending you the money. They're using your death benefit as collateral. So if you never pay them back, they will pay your beneficiary the death benefit that by contract they've already committed to paying out, minus any outstanding loans. So you could set your repayment schedule and say, well, I want to maximize what gets paid out in my death benefit to my beneficiaries, so I'm going to pay myself back. So let's say you buy an investment property and you use that cash flow to pay yourself back. So you're paying the loan back, but you set those terms. It's not something that the insurance company sets. It's not like a bank.
I'm moving house today. It's been 2 years, 8 months and 28 days, and I've got to say that as I step off the bus for what could be the last time spent as sitting in your boss supermarket queues, etc. And I have to say though, it's only today that I'm glad to be leaving. I really will miss the when Santa
listening to truthconduit.com with Chris Macmillan.
Okay, so let's start now.
What are we talking about?
We are talking about using whole life insurance to be your own banker. So that's the topic.
Ooh, I like that.
Do you know anything about that?
Okay. I do.
Okay.
I do that.
Well, let me introduce you. I'll introduce myself and you. So my name's Chris Macmillan. This is another episode of truthconduit.com. Woohoo! It's been a while since I've done an interview. My last one with Mike Nimitz. And so I'm really glad to get you on here, Lisa. I've been wanting to have you on for a long time. So Lisa is from Boston, and I had the honor of meeting Lisa through Richard Grove's autonomy class. And it didn't take long for my friend Lisa to prove herself as an explosion of value to the autonomy class. And you've been giving a series on this blows my mind. I never heard of this, but using whole life insurance, not term life insurance, but whole life insurance, how to be your own banker. And when I met you and you started talking about this, what is this? What are you talking about? And now you're doing a whole series on it within the autonomy group. And I just really wanted to talk to you about it to kind of reach a wider audience, because this is an amazing thing that I think the whole world should know about. So I don't know, in a nutshell, just can you explain what is whole life insurance and how can it be used to be your own banker?
Yeah. So I was doing things. I was working a job to be and all my money. And so I started studying what do banks do? How do I operate more like a bank? And I found this cool opportunity in insurance, specifically life insurance, because the IRS sees life insurance as an insurance product, not as an investment vehicle. So it's a really cool way to shove cash in and earn tax-free interest and dividends. And in the meantime, you're also getting a death benefit, which is really cool for a lot of people. You know, anyone that is interested in legacy wealth or tax-free legacy wealth, which is really interesting because you can multiply your money in a tax-free manner from generation to generation. And all of the money, for the most part, that you put in is available to you as cash value. So that you're able to bank yourself, you're putting in money that's compounding over time. You're actually taking advantage of compounding in a tax-free manner, and you can loan yourself the money. Sort of how it works. There's a lot of nuance to that, but that's the rough idea.
I mean, the first time you explained that to me, it was over my head. The key thing that made me finally understand it was it kind of works like an unsecured credit card, right? You're borrowing against your own, a secured credit card. You're borrowing against your own money. And that was when I was like, that's okay. That was a step for me in trying to get my head around that.
Yeah, so there's various ways of getting money into your policy. And these policies are part of mutual companies. So the mutual companies are profiting and then distributing it in the form of dividends to their policy owners, which would be you. So you get a portion of that tax-free. It's considered an overpayment of premium. So this money in your policy that you're contributing is earning interest and dividends. So it's compounding over time. It's getting, that pot of money is getting larger and larger. There's various ways of getting money into your policy. But once it's there, it's liquid and it's available to you. You get first right of refusal. This is a private contract with an insurance company. So it's your money, you get access to it. So you would call the insurance company and say, hey, I want to buy an investment property. You don't have to tell them this, but let's say you want to buy an investment property. You call them up and you say, hey, I want $50,000. The insurance company will look to your policy to see if you have $50,000 as collateral. They'll assign that collateral and the insurance company itself will write you that check for $50,000. Why does that matter? Well, your money is still sitting in your policy. You can't loan it to yourself again, but it's still sitting in your policy earning interest and dividends tax-free, while the insurance company has given you the money that you asked for that you can put into an investment that could be cash flowing or living your life. I mean, honestly, it could be used for anything. And it's a loan that you're taking from the insurance company that you set the terms. They're not going to set the terms. They're lending you the money. They're using your death benefit as collateral. So if you never pay them back, they will pay your beneficiary the death benefit that by contract they've already committed to paying out, minus any outstanding loans. So you could set your repayment schedule and say, well, I want to maximize what gets paid out in my death benefit to my beneficiaries, so I'm going to pay myself back. So let's say you buy an investment property and you use that cash flow to pay yourself back. You're paying the loan back, but you set those terms. It's not something that the insurance company sets. It's not like a bank. And what I liked about that is it gave me peace of mind. So it's saying, you know, I do due diligence when I do deals, but things don't always turn out exactly the way that I want them to. And even in real estate, I have properties that this year, everything worked until the government said, well, hey, if you're a renter and you don't want to pay your rent, like that's cool. We won't allow landlords to charge late fees or evictions. Well, so now my business model doesn't work. So my tenants aren't paying, I can't cash flow. If it was the bank, I would still have to be paying that loan back. But since I've loaned it to myself for my insurance policy, I could delay those payments until I have cash flow again.
Are there any limitations to what you can or can't do using this? Because isn't there a
yes
cap?
And no.
There's a certain cap where if you put too much in, then you'll start having to pay taxes on that. That's one thing that
Insurance companies are state by state. They're not federally regulated. So the only ruling that has happened was once in 1986, the Fed set a cap. So the IRS said there is a cap to the amount of money that you can put in a policy so that we can still consider it insurance and won't tax it. And that cap is adjustable. So it's based on the premium that you pay and the related death benefit. So that could be a $50,000 death benefit, or it could be a $50 million death benefit, depending upon who you are and your earning potential and your wealth. So it's not a fixed dollar amount. It's a sliding scale for every situation. But essentially they're setting what size premium are you adding? What will we allow you to add up to? And how is that related to the death benefit? So essentially it needs to look like an insurance product, not like you're trying to hide every last dollar that you have. And that cap is called MEC. It's a modified endowment contract. So people that set these up right, like the way that we set it up, is to minimize the amount of premium that you're paying to allow you to stuff as much cash as your goal is to stuff in there, what you're capable of doing without it being taxable.
I like that word, stuff, like you're stuffing your sock full of cash or something.
It's my favorite.
And I mean, every time I talk to you, I learn something new. Like, you know, I've listened to all your lectures and, you know, I have a policy and MEC. That's the first time, I'm sure I've heard it before, but that's for, you know, it just shows you, I mean, it's an exciting learning process. Why do you think, I mean, when you had to dig to find out about this, I found out about it through you and the autonomy group. I mean, why do you think that this isn't something that just everybody knows about?
I think there's a couple reasons. I found out about it through real estate investors and by just studying how the world works. So instead of studying how do I get rich, I started looking at how do rich people stay rich. So what are they actually doing? What allows legacy wealth to happen? What allows younger generations to blow old money and still have the family have lots of wealth? So I started looking at it through that lens, and a lot of big real estate investors use this to bank themselves, to do the down payments and for various other reasons. But it's a big tool in the real estate world. So I really learned about it that way.
Farmers as well. Wasn't it an old farmer trick?
So this is just something that farmers did. I mean, loans, leasing, financing wasn't such a thing back in the day. So farmers would have insurance on their properties and on themselves. And during times of harvest, they would have money, but the rest of the year they wouldn't. And so they'd borrow against their policy to do any work they needed to do on the farm and then pay themselves back, pay the insurance company back during times of harvest.
Sorry, go ahead.
This is something that people do. I think the other thing is the way that we set it up. This is a whole life insurance product. It is not any other product. It's not term life insurance. It's not universal life insurance. It's not just permanent life insurance. It's actually a whole life insurance product. So if you go to people that don't understand this, they will sell you the wrong thing. Why that matters. Insurance agents are paid on commission. And so the larger the premium that you're paying, the more commission making. So there's a couple reasons why insurance agents don't sell this. One, they want a large premium because they want to get a larger commission. A lot of people are really selling you something that will pay them well and support their families. Oftentimes people go to insurance agents for life insurance because they're looking for life insurance. They don't realize that the life insurance could do a lot more for them. So when someone goes to a life insurance agent and say, hey, I'm looking for a death benefit, they're sold a death benefit. I mean, how often are people not asking questions? Like if the agent is really well informed, they can ask questions and say, well, what are your goals? What is it you're trying to do? Do you know that there are options out there? Because you don't know, and if you don't know, and unless someone educates you. And what I found is a lot of people in the insurance industry are actually unaware of what's possible. Like they could sell life insurance their whole lives and have no idea that there's something else available to them and all of their clients. Like this really can be a win-win-win for the insurance companies, the clients, and the life insurance producers. So I think the people that are interested in utilizing this as a tool, there are a lot of resources to teach them and to educate them and to educate their clients. But otherwise, insurance companies make a lot of money on term life insurance and universal life insurance and other insurance products where the likelihood of the insurance company having to pay out is low. So people will pay premiums their whole lives or most of their lives, and then at some point it gets too expensive because of the way it's designed and it lapses, or people have paid in actually more than what the insurance company will end up paying out in the end. And so it's not financially sound for the client. So the incentive structure is a big reason that it's not something that insurance agents will talk about. But the way that these policies are designed to have your own bank, your base premium is as small percentage-wise as the insurance company will allow it. So we make it as small as possible, and then we make an optional maximum contribution called paid up additions, where you do make a one-time per year. It's not actually one payment. You're paying up for additional insurance each time. And every time you buy additional insurance, your death benefit goes up. So now you're paying out more to your family in the end. And the benefit of the death benefit going up is now your cash value is going up. So the higher your actual death benefit, the more the insurance company allows you to contribute and stay under the IRS modified endowment contract limit, which is the taxable limit. Does that all make sense? It
seems impossible for it to go wrong. I mean, unless you just completely quit, it just seems like once you get into this, it's just empowering all the way. I mean,
yeah. So it needs to be sized appropriately. So you'd want something, there are required premium payments. So you want to size it so that there's a minimum, no matter what, you can pay. And that can be on a monthly basis or an annual basis or however you want to set it up, but a minimum that you can pay, and there will then be a related maximum. So as your finances increase, you could get another contract that's a little bit larger. You just don't want something that you can't support. However, if you're able to support it for 7 years, the dividend payment generally becomes large enough around year 7 to be able to cover your base premium. So though this is not the optimum way to run your policy, you can keep it in effect. You can have it internally supporting itself. So it's just a peace of mind thing where it's like, you know what, we can't predict what's going to happen in 10 years, 20 years in our lives, in our finances, in our careers, in our entrepreneurial pursuits. We don't know, but we don't want the policy to lapse. So this is how we keep it in effect. Something else that's just like out of the box thinking. There's so much out of the box thinking. Let's say you wanted to cash your policy out for whatever reason. You cash it out. You say like, hey, I'm going to cash out. They'll give you your cash value. It's your money. You take whatever. Or you say, like, hey, Lisa, like I really want to cash out I want cash right now. I want to go big spending. I don't know. I just want to just throw it all away. The insurance company is only going to give me $120,000. You could try to sell me your policy. I could give you $200,000 for it because maybe your death benefit is like $1.5 million. Well, you know what? I know that you're guaranteed to die. So I could give you more money than the insurance company would give you because I'm guaranteed to get more money out of it in the end.
What about kids? So what are the advantages of a family taking out a policy on their kids? How would that work? Is that possible?
It sure is. The parent would have to have insurance in order to take it on their kids. It's a percentage of the adult's death benefit. I think it makes a lot of sense because a lot of parents and grandparents want to save for kids. The only options that I'm really aware of, the common options, are savings account, where you'll get like 0.01% if you're lucky. So basically you're losing money to inflation, or a qualified plan, like a 529 plan. And that has lots of complications, but that's market-based. And it's dedicated for specific educational purposes. So if your kids get to college age and decide that they don't want to go to college, or they don't want to spend the money on whatever the government is saying has to be spent on in order to not pay a penalty, now your money is locked up. And if you want to take it out, let's say your kid gets a scholarship or doesn't go to college, and you want that money back. Well, now the government's going to tax you and you're going to pay a penalty on it. That's crazy to me. So setting up a life insurance policy is really cool on kids because kids are young and healthy. So the actuaries look at them and they say, hey, this is a good bet. You can put money into them and it's going to grow really well. So year on year, that growth is going to be great, really good for kids. So by the time they get to 20, 30, whatever age, that cash value inside that policy has grown, and now it's a life fund. So it's, hey, I want to go to college, cool. Borrow money against the policy and pay for your tuition so you're not in debt. Or get married, or start your business, or buy lots of books and learn things, or build your own car. It doesn't matter what it is. It's your money. You call the insurance company and you use it. So over time, you're building up that cash value. And what the really cool thing is, as kids are growing, you can teach them how to take policy loans and how to structure the payback so that they're winning in the end. You could teach them how it's earning interest and dividends, what that tax-free growth looks like, what compounding looks like. Oftentimes we put money in savings and we save it up and we're like, oh, cool. Over the course of 20 or 40 years, I'm going to have a lot of money in the end. But that doesn't happen because we use our money. So you put money in an account, you save for 5 years, it earns some interest over that time, and then you buy something like a car, and then you save for 5 years and buy a house. Still 4 years of time. With life insurance.
Sorry, Lisa, you broke up for a few seconds. You said you buy insurance, you save for a car, then you buy and you save for a house, and then after that, I had lost you there for a second. What did you say?
So we're never actually saving for decades. We're never actually compounding our money over time. We're just saving for short periods of time and then going back to zero, and then saving and then going back to zero. Or the opposite, we're starting at zero, going into debt. We're using our debt and then trying to fight interest rates to pay back to zero. And then we go into debt again to buy that next thing we need to live. And then we try to get back to zero. And if you think about that over the course of your lifetime, in the end, you're hovering somewhere around zero, which means that's a little bit of a scary place to live in retirement. It's also not leaving legacy for anybody. Legacy is pretty cool. How do the wealthy stay wealthy? How do the wealthy have the opportunities to have influence and actually do things?
On the other side of that spectrum, what about somebody who is older and not in the greatest health? And they might think, oh, I don't know, I'm kind of older and my health isn't great. What would you say to them if they were considering getting one of these policies?
So these are all done on a case-by-case basis. So it depends upon the situation. If you say you're old and you're 55 or 60 or 65, you're not old, and definitely do it. And this is something that you can start with. The barrier to entry will be a little bit higher, and the growth, the performance over time will be slightly less than if you were 25, but it's still quite beneficial. And if you have generations below you, it's a multiplier. Whatever money you're putting in is guaranteed to be more money in the end. What's cool about the insurance companies is it's a private contract and it's guaranteed. So they will give you this contract that says, you pay this, we guarantee we will give you this. You pay this, we guarantee we'll give you this. Not a penny less. And every time they add money to it, so if they add additional dividends, that now becomes your new floor. So your guarantee gets bigger every year. So if you're middle age to old and healthy, I think that's great. If you're 75 and older or in really poor health, it would be a case-by-case basis, because the insurance companies will really have their actuaries look at your case, look at your age, your gender, and your health, and see what makes sense.
Yeah, cool. Now, we're entering some hard times, economic hard times. And one of the things that got my attention about this system was you had said how old it is. It's like over 200 years old. It's survived all the wars, the Great Depression. How did it, it has a pretty stable history. Any thoughts, comments about that?
So insurance companies are experts at long-term planning, because they have to be, because they've gone into contract to pay out death benefits, and death benefits can be decades down the road. So all of their planning is also decades long. They're not looking for big returns. They're not in the markets. They do very long-term loans, real estate developments, commercial real estate, policy loans, things like that. And they have a ton of insurance products that make them money where they never pay out. And the only times they pay dividends are to policy owners. So all of the term life insurance or universal life insurance or other insurance clients, they're not getting the dividend back. The insurance companies have paid a dividend every year, even during the Great Depression. So they have an interesting track record. I think the other thing is, there's two things that I think about. We don't know what's going to happen with inflation, but there is some inflation proofing. It's not a guarantee. If there's hyperinflation, like all hell breaks loose, who knows how to keep up with that? Then strategies change pretty dramatically. But by putting money in the form of a premium, you are multiplying it in the form of a death benefit. So your money is guaranteed to multiply to the next generation when you pass away. So that takes into account a lot of what inflation will be eating away and any other investment. And it doesn't have fees and taxes and all the other things that all investments have. The other thing is that when you're paying into this, so a lot of people want a death benefit anyway. They have families and they would like some protection. Like, they're the asset. All of the money is coming through them. They're the asset they want to protect to make sure their family is safe. Well, in life insurance, you get that, but you also have this pot of money, this cash value. Cash value is always liquid. It's always available to you. So let's say you see a change in the market, and maybe it looks like real estate is the place to be. You take a loan from the insurance company using your policy as collateral, and you put it into real estate, or you put it into silver, or you put it into whatever it is that you feel like, land or fossil fuels, whatever you think is a place to put your money. You take it out and you put it in there. Your policy is still going to earn interest and dividends, so it's still going to do the thing that it was doing, and it still has a death benefit. But now you can hedge your bets, and you have complete autonomy to do that. No one's going to ask you where you're putting your money, and no one's going to tell you where you can put your money. So if you think having dollars is not going to help you, you take out all of your cash value and you dump it into the things that you think are a safer bet. And that's 100% on you, so you can control your money. No one will restrict you taking it out. No one will ask you questions. It's how much do you want, how much is available, and where do you want us to send it?
Love it. What were some of your, when you were researching all this, what were some of the more influential books, resources? I'm going to link on the show notes, like the Nash book and a few others. What would you recommend to somebody who wants to dive deeper into this topic? What material, books, anything like that?
I think they should reach out to me and we can have a conversation, because it would be really fun. I think especially freedom-minded people, like I think some of the things, there's additional things, like the idea that it's a private contract, like debtors no one can look at this debt. This is a private contract. The insurance companies don't ask you for your work history, your financials, where you're going to put your money. They don't ask you questions. It's your money. They give it to you. And those are some of the things that I reacted to when working with the banking system. So anyway, I would like to talk about it. I'm launching a new website. It's called wealthbattle.com. Wealthbattle.com. Cool. It's almost live. You can check it out, but we'll work on that soon, ASAP. Nelson Nash, he was sort of like the father of this idea of using whole life insurance to be your own banker. And he talks about his experience, where he went right and where he went wrong with real actual numbers, which is fascinating. So he wrote a book, Becoming Your Own Banker.
Yeah, that's the one I read. What struck out to me was he used the supermarket metaphor. If you own your own supermarket, and that was really what hit home to me was, okay, you own your own supermarket, so it's normal for people to say, I'll just take this bottle of ketchup or whatever I need, and that's one of the biggest mistakes business owners make. And it was really
sneak out the back door.
Yeah, and you don't want to do that to yourself. You're cheating yourself. It's a really good book. Yeah.
So there's a lot of nuance to that, but essentially what they're saying is if you're taking a loan out and the insurance company is charging you 5%, you're going to want to pay back the loan in the ideal scenario. And sometimes people will say, well, pay back the loan at a higher interest rate. But what you're actually doing in that case is just tricking yourself into putting more money into your policy up to that maximum limit before it's taxed. So there's different ways of looking at it. It's sort of, I think, a mindset thing and how you approach it, and we can talk about that. Mindset's a really big thing. It's a paradigm shift of, hey, if I have money in the bank and I want to buy something, why wouldn't I use the money in the bank? That's free money. Why would I borrow money from the insurance company where I have to pay back an interest rate? And it really depends, because there is no free money. Like, we finance everything. So if you think about buying a car, putting it on a credit card, you're financing it. Buying a car using financing from some third party, you're financing it. Buying a car using cash from your bank account, you're financing it, because that's opportunity cost. If you're taking money out of your bank account, it's no longer available to you and you can no longer use it for anything else. So that's potential opportunity cost. And I have to tell you, when I started this policy and now that I have my own bank, I have interesting business opportunities that come up all the time. And I'm now tuned to look for them, because they're actually opportunities, and I get to say, do I want to invest or not? But they didn't exist to me before, because I only had whatever I had in the bank and I couldn't jeopardize that money. So you can store your emergency funds in there, and you can put opportunity dollars in there.
That's, the mindset and money. I really enjoyed your lecture with when you had your guest, Sarah, what was her name? Sarah
Sarah McCrum. I can send you a link too if you want to see some of her things. I could share that with you guys.
Definitely. Yeah, whatever links you have that I'll put for people to kind of dive deeper. And so wealthbattle.com. And didn't you have another website up and running, or is that obsolete now?
Yeah, we switched it. We switched it to Wealth Battle.
Okay.
So now
cool.
there'll be some videos, some group calls, more of a community-based thing.
That's exciting. Very
And I mean, my goal eventually is to say, well, hey, there's a lot of people that are entrepreneurial. They have the right mindset. They want to start their own bank, but they might not have a ton of funds to put in it right now, but they're going to start, and they're going to start building it. There's other people that have worked regular jobs, had inheritance, whatever it might be. They have a lot of money, similar mindset. They've now created their own bank. They're ready to utilize their money, but they don't have a reason to. They don't have a purpose. They don't have something that they're working on. So now I feel like in the community, we can now support each other better. So someone that has an entrepreneurial pursuit can be funded within the community using all private money.
That's what it's
That's
all
pretty
about
cool.
right now, isn't it?
Yeah.
You know, it's that's what it's all about. Controlling your own money, being your own banker. I love it. Lisa, Manfredi, do you have any final thoughts before we wrap up?
I know that this was one of the biggest life-changing things for me. It really changed my mindset on money. I had this scarcity mindset, and I would definitely be interested in talking to anybody that just wants to learn more about it, because it was the single most influential thing in my life. So absolutely, I'm really glad that you put this together, Chris. So thank you.
Well, I certainly sleep a lot better. You know, of course, I worry about the future, but a little bit less now that, you know, I've got my own policy up and running for myself and the family. So thanks to you, Lisa. Thank you
Awesome.
very much. Well, cool. Well, thanks for coming on, and I'll talk to you later.
Okay, thank you. Bye.
Walking down the street, the children play. For them, it's just another day. The future's reflected in their parents' faces, who chose to stay on in this place. Well, they were born, went to school, got married, had kids, like their grandparents before them did. Got to escape, you know, before it's too late. Although today I could say that I really will miss the when Santa. But yeah, I was right. Knew what it was like when Santa.
You've been listening to truthconduit.com with Chris McMillan. Go to the subscribe page and sign up to get notifications of the latest posts. And check out the support page to help keep it going.
Yeah, I've got a friend in Jesus Christ. I've got a friend in Jesus Christ, and Krishna and Buddha and my bartender.